Welcome to ForexTV.com's PM Exchange. It's Wednesday, January 2nd. I'm Remy Hokie. Today I'm joined by David Powell, currency strategist at IDEAglobal. Good afternoon, David.
Good afternoon, Remy.
Happy New Year.
You too.
Well, in today's session, as we start off the new year, we've seen quite a chill on Wall Street today with equities tumbling, and also we saw commodities rally and crude oil top $100 for the first time. But let's start out with a look at the dollar, which fell on weak data as well as risk aversion. So if we could start out and you could tell us about the fundamentals weighing on the bearish sentiment.
Sure. Today we saw the release of the December U.S. ISM Manufacturing Index, which declined much more than expected and fell below the important 50 boomer bust level, indicating contraction in the manufacturing sector of the U.S. economy. This was definitely weighed on the equity markets, and also saw the futures market increase the price-to-earn probability of 50 basis points of easing at the January 30th meeting to about 25%. That compares to about 0% that was priced in on Monday. And of course, a 25 basis point cut remains fully priced in.
Okay, and moving on to the major pairs, today we saw the yen soar across the board against the major currencies. And taking a look at dollar-yen, we saw the pair rally in the New York session, breaching 110 and falling to a low of 109.32. And also euro-yen fell to a low of 160.94. So going into the coming session, if you could briefly give us both your fundamental and technical outlook for the yen.
Right, the yen was definitely weighed upon by the declines, which were rather significant in the U.S. equity markets today. And moving into the Asian session, the declines for dollar-yen are likely to continue, with initial targets seen where support is formed around 108.25, which is the November 28th low. However, on a more multi-day basis, we see potential for dollar-yen to drop to the low for the entire month of November, which comes in at 107.20.
Okay, David. Well, while we're looking at the yen, we saw a massive carry trade liquidation in this session, and we saw the sterling, which also tumbled across the board. Sterling yen hit 216.41 in today's session. But given fundamentals in the UK, if you could give us your outlook for the sterling yen cross.
Right. We did see some carry trade liquidation. However, some of the high yielders did hold up pretty well, such as the Australian and New Zealand dollars were not terribly affected today. In terms of the pound itself, there is a weakness in the UK economy that's being seen. Of course, we saw further evidence of that overnight in the form of a manufacturing survey which showed significant declines, and this supports the notion of further easing from the BOE in 2008. And we at IDEAglobal look for a full 100 basis points of easing throughout the course of the year, and this has weighed on sterling. However, we don't think that the sterling sterling dollar cross is the best way to express this view of sterling weakness, given the fact that the dollar is also likely to weaken in 2008. And we also see that there is a potential for weakness on the sterling yen cross, but our preferred avenue for pursuing gains, for pursuing a bearish view on the British currency is to be long euro sterling, and at that stage the pair is still poised for further gains, and we have an initial target now of 75 coming up pretty soon.
Well, David, it's interesting you mentioned euro sterling, because we saw that hit another record in today's session. And we do have the BOE as well as the ECB meeting coming up next week. So if we could discuss euro dollar, since we had the FOMC minutes come out and we saw the pair head above 147. What's your outlook for euro dollar as we head closer to the end of the week, where we'll also be seeing non-farm payrolls?
Right. Well, in the short term, such as Thursday's Asian session, we do look for Eurodollar to continue its rally. Our initial target comes in around 147.85, which corresponds to the November 23rd low, where resistance is seen now. However, throughout the rest of the week, we're likely to remain in an environment of dollar weakness, with the market, as you mentioned, concerned with the FOMC minutes, which had a rather dovish tone to them, and the market also looking forward to Friday's non-farm payrolls report, where there's an expectation for further declines in the number of jobs created on a monthly basis, which of course would be a sign of a weakening U.S. economy supporting further easing. And this comes at a time when the ECB is firmly on hold for the time being, and that message is likely to be reiterated in next week's meeting, leaving the euro-dollar pair supported on the road to 150, and we look for the pair to end the first quarter somewhere around 155.
Okay, well, before we move on to the commodity currencies of the Aussie as well as the CAD, if we could briefly take a look at the Swiss currency. In today's session, the dollar Swiss opened around 112.57 and tumbled to around 111.50, and we saw in today's session that the VIX climbed to the 20s. But since the Swiss as well as the yen gained the most against the US dollar for the rest of this week and going into tomorrow's session, what is your forecast for the Swiss currency?
Right. Well, the outlook is for further gains, given the fact that the U.S. dollar is depreciating across the board, and also that as carry trades are unwound, this does involve buying of the low-yielding currencies, such as the yen and the Swiss franc. And in the near term, we look for a drop on the dollar Swiss to 110.70, which is the November 26th high, where support is currently being seen.
Okay, and last but not least, in today's session, since we saw a rally in both oil as well as metals, especially gold rallying over $22 to $8.60 an ounce on the NYMEX, let's take a brief look at the Aussie dollar as well as the Canadian currency. So going into the rest of this week, if you could briefly give us your forecast for Aussie dollar as well as CAD.
Right. Well, as the Australian dollar has strong fundamentals, we do believe that the currency will remain supported in the medium term. However, in the short term, the commodity currencies, especially the Australian New Zealand dollars, have been somewhat sidelined, and we do look for just further range trading over the next day or so, given the fact that they have been subdued and they haven't reacted as much to this dollar sell-off. However, in terms of the Canadian dollar, there's a risk that we see more movement there than the other commodity currencies, given the fact that not only is the dollar depreciating across the board, but also that oil hit a new record high today. And we could see a dollar CAD decline to its 50-day moving average, which comes in around 98.05. However, we would like to stress that these are probably short-term declines, and over the medium term, we do not look for further significant appreciation of the Canadian dollar, as the Bank of Canada has confirmed. It's on a it started a monetary easing cycle, and there are significant risks to the Canadian economy moving forward.
Okay, David, as always, thank you very much for coming on the show.
Pleasure to be here.
This has been your Forex News with David Powell from IDEAglobal. Next up, we have your equities and commodities wrap-up for the day. U.S. stocks started off 2008 with steep losses. Commodity prices soared, and the latest manufacturing data release fueled concerns about the economy. This pushed the Dow to its worst point decline for the first trading session of a new year. In today's economic data, the ISM Manufacturing Index fell to 47.7% in December from 50.8% in November. This was the lowest since April 2003. Meanwhile, the Commerce Department reported that private residential construction fell in November by 2.5% to an annual rate of $484.9 billion. At the closing bell, the Dow Jones Industrial Average tumbled 220.86 points, ending at 13,043.96. The tech-heavy NASDAQ fell 42.65 to close at 2,609.63, and the S&P 500 slid 21.19 to end at 1447.17. In the fixed income market, U.S. Treasury prices started off with a rally. This came following the ISM manufacturing report for December. The benchmark 10-year yield fell back below 4% with its yield at 3.93%. It was at its weakest level in a month and down sharply from the 4.02% in late Monday's session. The 30-year bond surged 2 whole points with its yield at 4.37%, down from 4.45% in the previous session. The 2-year note advanced with its yield at 2.91%, down from the 3.05% in Monday's session. Taking a look at energy, crude oil futures hit the $100 a barrel mark and ended up by almost $4 a barrel. February crude soared $3.64 to close at $99.62 a barrel on the NYMEX. In today's session, crude futures rallied $4.10 to hit $100 a barrel in early afternoon trading. Meanwhile, other energy futures also ended higher. February RBOB gasoline gained 7.81 cents to close at $2.56.89 a gallon. February heating oil soared 9.1 cents to close at $2.74.04 a gallon. And February natural gas futures also rose by 36.2 cents to close at $7.845 per million BTU. Over in the metals complex, gold futures rallied today by $22 to end at their highest level since 1980. This came as crude oil futures hit $100 a barrel, and also as the U.S. dollar weakened against the majors. Today, COMEX gold surged $22 to close at $8.60 an ounce. It hit an intraday high of $864.90 an ounce. And in other metals, March silver rallied 37 cents or 2.5% to close at $15.22 an ounce. March copper rose 2.3 cents to close at $3.0640 a pound. This afternoon, we're joined by Derek Fry from ONF Futures and Options. He'll weigh in on soaring crude oil and gold futures and give us his outlook heading into 2008.
Okay, recapping the action that we've seen today in the energy and metal sectors, what a wild day it's been, obviously. We've seen some extreme moves. First thing I want to do is just caution everyone about the movement that we've seen today. First of all, we are still largely in holiday mode today. Liquidity is still very low across all markets, commodities, stocks, bonds, everything. So keep that in mind when you're taking a look at these some of the movement that you've seen in the last 24 or 48 hours. All of these extreme moves again have been done on the backs of very low volume and low liquidity. So you do want to try to take them with a bit of a grain of salt. There is a strong probability that we could see a lot of this movement move back towards the mean as more liquidity and more players come back into the market. This week and, of course, next. Next week will be our first full real week with full volume and everything else. The remainder of the week volume should increase each day, but really nothing is back to normal until we get into next week. So that being said, gold did push through the magical 850 level and touched 860 briefly. Again, I don't expect to see too much follow-through in the short term. Look for a pullback. And moving quickly over to the energy markets, of course, there's some controversy, I must say, about whether or not we really did test the $100 level. I know that the pit did trade $100, but the fact that the electronic was quite far away from it does leave the possibility that that trade will be, quote-unquote, what we call whistled out, or basically taken away or disallowed. So we'll have to see tomorrow if they, in fact, allow that trade to be real or not. But either way, the bottom line is whether we're at 99.50 or 100 is really irrelevant for the underlying economic picture. And obviously the two key markets that we're talking about here, gold and energy, are sending a clear signal to the Fed that inflation concerns should probably be pretty high on their radar screen as we move forward. And judging by the statement in today's minutes, it looks like they are getting that message.
That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. Thanks for joining us for today's edition of PM Exchange. I'm Remy Hokie. Join us tomorrow morning for your latest news update right here on ForexTV.com. Have a good night.